Okay, so here we are, Friday edition of The Open, and we opened higher in Toronto and New York. We're digesting the latest inflation numbers in the United States, trying to figure out what that means for interest rates. But it seems like the earnings story, particularly big tech, has taken most of the headlines this morning, helping the NASDAQ in a bigger way. But is it North America you should be really keying into for the best returns going forward, or should you look a little further afield? Let's get perspective now from Petursson. He's Chief Investment Strategist at IG Wealth Management. Nice to see you.
Good to be here.
Let's just start with, got to do all these exercises and mechanics on like where the market's thinking is on things like interest rates. So you have sticky inflation evidence this morning, but it was basically in line with Wall Street's expectations. Wall Street has been recalibrating, it has felt like recently. How do you think about inflation and when we see interest rate cuts and how the stock market is performing amidst all of that?
Well, it's a great question. And I think it's a tale of two stories in a way. You have one that is betting that the markets will go up only on a Fed cut or how deep the Fed cuts. And I think it's a little misguided in that sense. Then you have the other side that says, no, it's all about earnings and results. And that's what I think we're seeing in the markets over the last couple of weeks. In general, I think inflation is coming in as we expected, which is stickier, as you point out, in that we have the PCE just below 3%, you have CPI above 3%, and I think the 3% mark is where we're likely to stay over the course of the next 6 to 9 months. That's not going to prompt the Fed to be aggressive with interest rate cuts, and in fact, I am becoming a little bit more of maybe the consensus that 2 or less is the likely story.
I should remind our audience, we do have a presidential election as well, so it almost feels like the window to sort of move into that kind of stuff starts to get a little bit clouded by politics come the fall.
Exactly, and that's the thing. It's the Fed needs to go sooner or they're going to go after the election because they don't want to be seen as influencing the results one way or another.
So everybody's getting their head around it then in the market. I should point out, though, I believe it's the Bank of Canada told us that they're not expecting inflation to get back to their target until next year. But there is this buzz that we will see a pivot towards rate cuts sometime pretty soon in Canada. Do you feel that way too?
I agree. And in fact, it's interesting that they say that because the way we model out Canadian inflation, I can get it to the Bank of Canada's target a lot sooner, before the end of the year. In fact, it looks like late summer, we could see Canadian inflation at 2%.
And is that because people are a little stretched by the debt realities, the interest rate environment, and they're showing signs of spending less than they might otherwise?
Yeah, it's that, and it's also base effects. And look, with the mortgage rates having stabilized, the impact on mortgage rates to inflation is starting to come down. So that's where we're seeing just a natural progression lower for Canadian inflation, which I think supports the Bank of Canada for cutting much more aggressively than the Fed.
Okay. On the earnings front itself, one headline I saw on Microsoft and Alphabet, both leaders in the AI field right now, is that the market is determining with these results that those AI bets are paying off. And that maybe is, it's the story of the year, maybe it's the story of the decade, this idea that spending on AI, which is happening in every industry, can be a catalyst for growth for our economy, the U.S. economy, the global economy, and we largely see it through the lens of Microsoft and Alphabet. It's like a different economic bellwether measure, but I think everyone's been wondering if AI is just a hype cycle, and then we're going to move on to something else, or whether it actually can solve things like productivity and all these things we talk about. So where do you land on that?
Well, I don't think it's a hype cycle, but I also don't think that you can measure immediately today the impact of it. I think it is a decade story as opposed to a 2024 story. But in seeing some of the things that Microsoft is implementing in Teams and in their Office 365, I do think that the AI applications that they're putting in place will lead to greater productivity. We're seeing it on our team. I can see that across the industry, and this is something that you can monetize.
Yeah. So we'll watch what happens on that front. I guess if we're talking about geographically where we're investing right now, like we talk endlessly with you about how the U.S. lots of options there, but tech rules. Here in Canada, we've got more cyclical exposure. We've got more exposure to a broader net. When it comes to investing in Canada versus investing in the U.S. versus investing other spots around the world, what stands out to you right now?
Well, I think the U.S. still looks quite strong. We are seeing growth. Yes, growth softened in the first quarter to 1.6% annualized, but I think that's fine. I think with the trend for growth is still up, not down. And so that leads to better earnings growth in the United States as well. Canada, I have to say, is a little bit of a wild card. On the one hand, our general belief has been that the TSX doesn't have quite the same opportunity as the S&P 500, but then it's predicated on where oil goes. And if we continue to see oil price appreciation, gold price appreciation, base metal price appreciation, well, guess what? That's a catalyst to see the TSX do well, if not better, than the U.S. We're just not 100% convinced that that's the direction that we're moving in yet.
What about from our banking sector? How does it fit into the equation?
Well, the banks have had a great run since the fall. If you look at them measured on their historical valuations, price to book, price to earnings, they're right back in line. So, how much more room do we have for the banks is, I think, dependent on where interest rates go and how the Canadian economy does. And that all centers around the consumer. So I think the banks will be fine. Looks certainly attractive dividends and reasonable valuation. There might be just better opportunities in other sectors of the TSX.
Okay.